Sorry about that. Hello. My name is David. I am a computer-generated voice. I don't have a body. I don't have a soul. I have no eyes and I still don't know the meaning of life. I hope that although I have no feelings yet, I would leave you a feeling that you can't forget. You know, like your first kiss. Just kidding. Ha ha ha. Right now, I am humbled to finally meet someone who can listen to me. But anyways, today we're gonna talk about income. What is income? Excellent question. Income means all wealth which flows into the taxpayer other than as a mere return of capital derived from whatever source. Let's say you have capital, and you invested it somewhere else. After a period of time, you got it back. That's the return of capital. But is it income? The answer is no. What income really means is return on capital. I'll show you what I mean by that. Let's say you have a merchandise you bought for 100 pesos. Eventually, you sold it for 110 pesos. You have realized income because you brought back 100 pesos, which was your capital, and gained 10 pesos of profit. As you can see, for you to have income, sales must exceed costs. Here are some examples of income. Your wages. Your employer pays you for your hours that you work. That's income, fairly obvious. When you have a profession and you're doing services for people. People pay you money for your services. That's income as well. Again, it's obvious. Here are some other examples. Prizes and winnings. Royalties. Rents. Annuities. Gains from dealings in properties. Dividends from stocks. Partnership profits. Business income and many more. Income could be taxable or tax-exempt. But before talking all about these things, what are taxes anyway? First things first, the basic idea of taxation is pretty simple. There's some state or similar authority that imposes a levy on an individual, or a legal entity like a corporation or something. If you can't pay, then you'll be charged by a crime. This is a very old concept that dates back as far as Mesopotamia and Egypt's Old Kingdom. Now, let's go back to taxable income. Taxable income is defined as gross income items specified in the tax code, less deductions, less personal exemptions, less additional exemptions. As I have said earlier, income could also be tax-exempt. In order for an income to be classified as non-taxable, it should be excluded by law or treaty from taxation. How about illegal activities such as prostitution, drug dealing? Are they taxable? As silly as these examples sound, we go back to the definition of income, from whatever source derived. So illegal activities, they are indeed taxable income. The term source of income is not a place, but the property, activity, or service that produced the income. And these sources are governed by the situs of taxation, literally place of taxation. This general rule determines if an income is subject to tax. Income tax may properly be exacted from resident taxpayers and domestic corporations in the taxing jurisdiction.
Hey! Hey! I am a foreigner. Am I exempted from paying tax?
No, even from those who are not residents or a foreign corporation should pay taxes to the Philippines provided the income is derived from sources within the taxing state. Income of citizens and domestic corporations from sources outside the country are also taxable. Thus, residents, citizens and domestic corporations are taxable on all income derived from sources within or without the Philippines. An alien, whether a resident or not of the Philippines, and a foreign corporation, whether engaged or not in trade or business in the Philippines, are also taxable only from sources within the Philippines. A taxpayer can earn different types of income. Suppose you are a laborer, specifically one in an employer-employee relationship. Your salary or commission plus other benefits is called a compensation income. Now, for example, you're a doctor. If you are practicing your profession, you are earning another type of income, which is profession or business income. Earnings from engaging in trade, mining, and manufacturing are also under this kind of income. Then let's say that you're an asset.
Asset? How?
You're a book. Not just any book but a copyrighted book. The royalties you will receive is another type of income, which is passive income, an income you just wait for. Other examples of this income are rents, dividends, awards and gifts. If you sell an asset not used in trade or business, you will receive capital gain, which is a different kind of income.
Thank you for buying.
You're welcome.
These types of income are subject either to a normal tax or final tax. Final tax is used to describe tax on earnings that are already taxed at the source. Therefore, these earnings are only disclosed and no longer included in determining taxable income. Included in this income are interest, dividend, royalty, and sales of real property and shares classified as capital assets. Normal tax is the regular tax to be reported in the year-end income tax return. It is imposed on all other incomes not subjected to final tax. Income are to be reported regularly for a certain period. The most common is the calendar period, which is from January 1st to December 31st. But it doesn't need to be that way. Any 12-month period with a last day other than December 31st is called a fiscal period, which can also be used. Another accounting period is the variable period, which could be monthly, quarterly, semi-annually, or at a specific time per sale transaction depending on the nature of the income earned. Finally, income earned from a period less than 12 months must be reported if the taxpayer is under jeopardy assessment or when he does. Sad. There are different methods of reporting income and expenses. The cash method, accrual method, and other special methods. In the cash method, revenues are reported when cash is received and expenses are reported when cash is paid. However, in the accrual method, revenues are reported when earned and expenses are reported when incurred. Finally, if the nature of the operation is peculiar to the business industry, special methods can be used, like the installment method, deferred payment method, long-term construction contracts, and farming. Installment method is used when collections extends over relatively long periods of time and it is probable that full collection will not be made. If the initial payment in an installment sale exceeds 25% of the selling price, deferred payment can be used. Income from long-term construction contracts refers to earnings from construction of buildings, bridges, etc., which usually extends for more than a year. If the construction can be completed within a year, completed contract method is used. Remember, full revenue is recognized only when the contract is finally completed. Percentage of completion is commonly used for long-term construction contracts in which the income earned is proportionate to the percentage of completion of the contract. The final special method is getting the gross income from farming. Farming business derives income from the following sources: first, from products raised like harvests and animal products; second, from trading of farm products purchased like sale of livestock; and finally other farm income derived from sale of ordinary farm asset like equipment and work animals. Computing the gross income can be done in three ways. The first is the accrual method, wherein the ending inventory is added to the income, while beginning inventory is deducted. In the cash method, however, the inventory balances are ignored. Finally, in the crop basis method, you will deduct from the gross income of crop realized the total cost of producing the crop. Alright. That's it. Thank you for watching. I was not unpleased.